Welcome to today's webinar, CIO's Insights on Investing in US Equities, hosted by CFA Society India. I would like to take a moment to welcome our audience from around the world joining us remotely today. My name is Biharilal Deora, and I'm a volunteer with CFA Society India. In my day job, I work with a Category 3 Alternative Investment Fund, and I'll be the moderator for today's webinar. Before I introduce our speakers, I have a couple of housekeeping notes. Today's webinar is scheduled for about 60 minutes, including question and answers. We'll be leaving time for Q&A after the presentation. Please feel free to submit your questions throughout the presentation on the Q&A tab. You can also do so by clicking on the Q&A link at the bottom of your viewer screen and typing your question in the box. The webinar recording will be available after the presentation concludes. We value your feedback, so please complete the evaluation survey, which will be shared live before you sign off today. Now, it's my pleasure to introduce our speaker for today's webinar, Bhavin Shah. Bhavin is one of the most awarded equity investment professionals in the world, having achieved an unprecedented streak of 10 years, almost a decade, for #1 ranking by the Global Institutional Investor during his work on Asian and global technology sectors. In his career spanning over 2 decades, Bhavin has played leadership roles in building from scratch 3 top-ranked institutional equity franchises globally at JP Morgan, at Suisse, and in India at Equirus. Prior to joining the financial industry, he worked as a microprocessor design engineer and jointly designed the world's fastest Alpha Microprocessor and successfully registered 2 US patents. Bhavin has set up Sameeksha Capital, where he is the CIO, to manage his personal savings in an institutional setup and hence enable others to benefit from his expertise. Bhavin holds an MBA degree with Beta Gamma Sigma honors from the top-ranked Booth School of Business at University of Chicago and a master's degree in computer engineering from the University of California. Welcome, Bhavin, and thank you for doing the webinar for us. Over to you.
Thank you, Vini, for that introduction, and good afternoon to everyone. Let's go straight into the topic, and just a disclaimer to start with, that this presentation is primarily for discussion purposes, and please consult financial experts for a very specific investment advice. And we may have a financial interest in some of the ideas that we mentioned in this discussion. With that, let me sort of talk about how we got here. And I think it is important to recognize that even a disciplined investor in India, I'm putting aside the speculators, the trading mindset oriented, but even the disciplined investors have reasons to be disappointed. Because from a period from January 2010 till April 2020, Nifty has returned 6.6% annualized, and even an investor who is doing regular SIP has got a similar return. So that persistence and consistency hasn't really paid off. In fact, for most disciplined investors, the portfolio will probably be showing negative returns over the last 3 or 4 years. So we talk about mutual funds sahi hai, but really, if you look at on a rolling basis, only a handful of large cap funds, and by the way, those names keep changing all the time, have been able to outperform Nifty, and that number keeps shrinking. And same is true for broader market funds versus the relevant index. And now the real trick is that among those handful, selecting which fund will outperform in future is really an almost impossible task. So we think that in future the slogan could be, index mutual funds sahi hai. These funds have much lower expense ratios compared to the active managed funds. However, the issue is that India does not yet have enough choices for the index funds. Especially for example, we don't have any. I don't believe we have any fund which mimics the performance of the 500, CNX 500, for example, and so on. So we're still in the early stages of this. But anyway, the main point here was that the performance is really disappointed, and we can look at this in different ways. Here we have a comparison of S&P 500, the US market returns in US dollars versus CNX 500 returns in US dollars. And last 10 years, India has really underperformed, and clearly currency depreciation has played a meaningful role there. I mean, really the golden period of Indian stock market was during that global economic boom that followed the 9/11 events and post that, and up to the point of global financial crisis. Post that, it has really been a very sluggish market. Next slide. So, and to look at this, to look at from a point to point sometimes can be misleading. So we also try to look at the same data from a rolling basis, rolling 3 and 5 year returns. And what you see is that Indian market did really well for quite some time compared to the US market. But I think the story changed from sometime in, basically post global financial crisis. So as still looking at this long period, about 20 years of data, on a median basis, if you take a 5 year view, Indian market has given higher returns. But that has obviously comes with a higher volatility. Clearly the standard deviation of the volatility for Indian market is higher. But again, if you look at it on a 3 year basis, the returns have become more comparable. So just trying to understand what has really happened. On the next slide. So one of the things we looked at is what has happened to the profitability of the companies in India and in US. So what you would notice here is that Nifty 50, the 50 stocks in Nifty had superior ROE for foreseeable time, period, for a sustainable period, and that sort of has changed in last few years. And even more important is something we look at, which is a difference between the return on equity and the risk-free rate. As you would understand, the interest rates do play an important role in defining the value of equities. The higher the interest rates, the lower the value for equities because of the discounting. And this spread between return on equity and risk-free rate, that's where the gap has really opened up. If you look at the right-hand side chart and look at that blue line significantly above the red line. And this is a key factor that has explained, the reason for underperformance of India. Next slide. So, I mean, and I'll go back to that point in a bit, but let me just now talk about some of the key reasons or, the case for investing in US market. I mean, I think anyone who's studied portfolio theory would tell you that, a lot of you have, that geographical diversification, is always, you are expanding your efficient frontier, you are exposing yourself to bigger, more markets, and, that leads to reduction in overall volatility and also higher return. So that's just a standard classic portfolio theory working for us. And by investing in US though, what you get is not only exposure to some, big successful US companies, as well as many emerging companies, but you also get exposure to global leaders based outside US but listed in US either directly or through a secondary listing. So you really from one place you can, you sort of one sort of place you can shop around the world, so to speak. And interestingly enough, and we will demonstrate this later, that valuations for the US market on a relative basis to India are actually still attractive despite the recent run-up. Obviously, one may want to take a pause based on this recent run-up, but I'm just saying relative attractiveness is still there. So let's look into some of these points in detail. So the we try to look at the diversification aspect, and when you look at the correlation of various asset classes, the US market, the Indian market, gold, the REITs, the REIT is a very big market in US. In India, we have a few REITs which have listed. It's still an early stage, but REITs is a big market in US. And you can see that, for example, India and US, it's a positive correlation, but it's not a very, very strong correlation. And this is just one number over a very long period of time. In between, there are periods in which you would see meaningful, deviation between the markets. And, so that is one clear benefit, of diversifying outside of India. Next. So what kind of companies, I'm sure you have heard of some of these names, but I would like to make a couple of important points here. That in each of these, technology, everybody talks about, you get exposure to great, world leaders in technology. But, here, I just don't want to talk about Microsoft and Apples of the world, but even companies like, say, TSMC, which is the Taiwan semiconductor company. Basically, if you're on this call using a laptop or a phone, the chips in that device are made by TSMC. So, you get exposure to companies like that. If you look at the internet, you not only get exposure to companies like Alphabet, but also Alibaba. Obviously, global financial players who have been around, for a very, very long time. Some companies around for more than 100 years and still very successful. Innovative players in healthcare. So this is the exposure we don't get when we invest in India, and this is going to become even more important going forward because one of the recent changes that government made is to allow companies to list directly in US. So, for example, you might have heard of a company called Zoho, which is actually a very successful company from India in the accounting and other cloud-based products. And chances are they might list directly in US if they ever list. So, I think even from that perspective, it becomes important. Next slide. So I wanted to elaborate further on the story of India versus the US a little bit. And I've kind of taken three timestamps. The sort of early 2010, sort of sometime in 2015, and then today. And what you can see is that there is not much to choose between the two markets in terms of PE multiples. However, the story on the return on equity, which I was mentioning earlier, is where things have really changed. Indian return on equity, and by the way, Nifty 50 keeps changing, right? So you keep getting better companies in Nifty 50. The weaker companies get kicked out, and still the return on equity for Nifty 50 has deteriorated, whereas that for US has improved. And if you look at the risk-free rates, there is obviously always a big difference, big delta. So when you look at the difference between return on equity and risk-free rate, the spread, US, the S&P 500 is a big advantage. And one way to look at this is a ratio of price to book divided by return on equity minus risk-free rate. And you'll notice, and I have sort of circled those figures, that on that basis, the lower that value, the better it is. And the US market is looking far more attractive than the Indian market on that matrix. And apart from the deterioration in return on equity, the problem with India has also been growth. The EPS growth for Nifty on a US dollar basis, whether you take 5 years or 10 years, there's not much to talk about. So both the lack of really good growth and deterioration in return on equity vis-a-vis relatively higher interest rates are the factors that have really affected performance of Indian market. And despite better performance, even today, the US market looks relatively more attractive. We kind of took instead of just looking at the index, we said, let's look at some of the key stocks in both markets. So we created a basket of some of the largest Indian stocks, also the basket of some of the largest US stocks, and we separated the financials and non-financials, because some metrics work better, differently. So, earnings yield, while Indian stocks still have a lower earnings yield, compared to the US. And when you bring in the risk-free rate, and I keep talking about risk-free rate because interest rate plays a big role in valuation. The spread for the Indian stocks is negative, whereas it's still modestly positive for US. when you look at the price to book, you realize how expensive some of the Indian stocks, especially these popular stocks, with the ones that a lot of people keep talking about. And you look at the free cash flow growth, the top US stocks versus India, and we have not done really, we have not done well actually. I mean, we have not been that great, and that is really what has been reflected in the share performance. I mean, some of these Indian stocks have done well, but it's purely because of valuation increase. And essentially this framework or this sort of phenomena that is happening in the market of quality at any price investing, and I think there's a lot of money chasing some few names. Some of these stocks perform well, so those portfolios look good. More people put money into that. I mean, it just becomes a self-fulfilling prophecy. Someday, that story will not end well, in my view. So I think the point here is that fundamentals clearly tell you that the rally in US stocks is far more justified than that. I mean, I'm not talking about last 1 month or 2 months, but I'm talking about sort of a longer term here. That the rally in the US stocks is far more justified than that in the Indian stock. I think the data here, I think clearly demonstrates. Even the financials, you can see that earnings growth has been much weaker for Indian financials versus US financials. So yeah, so go to the next page. Now, one more thing, okay, we talked about the US, but what about emerging markets? Now, interestingly enough, emerging markets haven't done that well. In fact, 10-year performance of emerging market is not very different from that of Nifty. So, why are we bothered with emerging markets? Well, the point is that when I look at the emerging markets today, they are more attractive. We just taken a data for one ETF for emerging markets, and clearly they look more reasonably valued, only 1.4 times price to book, decent cash flow yield, reasonable dividend yield, and pretty decent track record of earnings growth. And then I look at some of the stocks that comprise this emerging market ETF, and there you see, I mean, Alibaba, Tencent, TSMC, Samsung Electronics. We're talking about global leaders. These are very, very strong companies. I mean, Tencent is really a Chinese company. I mean, China-focused player, but the others definitely have a very strong impact on a global scene. So I think that even the emerging market story could look more interesting, instead of in just India going forward. Next. So just to talk about the US market, what opportunities do we have? How do we invest? And I'm going to talk primarily about ETFs today. I'm not going to talk about investing directly in stocks. I think if somebody has the ability, time, everything to do that, go ahead. But I think ETFs themselves offer huge sort of choices. I mean, there are, in terms of the asset base, in terms of the number of ETFs available. I mean, it's just it's like an ocean. You can get really you get spoiled for choice, basically. One important thing that I really like about the ETF market in US, that the index ETFs, they have very low expense ratios. In fact, there's so much competition that some of the expense ratios have gone down to as low as 0.03%. They're very liquid. I mean, there are especially some of the large ETFs are extremely liquid, very easy to buy and sell. I mean, try selling some of the mid-cap stocks in India, and you know what it takes, especially if you're buying in a larger quantity. So I think these are some of the key advantages, and we'll elaborate on some of these points next one. I mean, just to give you an example of what kind of options we have. Clearly, you have S&P 500 ETFs, covers the broad market. You can even have a ETF covering the the total US stock market ETF. You have mid cap, you have small cap, and then you can slice and dice this in many different ways: growth, value, dividend yield. You can do sector ETFs, and not just sector. Why just sector? Subsectors. Cloud computing. You can go into software companies, or just I can keep going on and on. Even some of the more sort of modern ideas like multi-factor, looking at different factors that affect market, and people come up with these ETFs. Somebody likes dividend yield. Also, one of the things that idea that is being talked about that I think it could be interesting is, given the level of stimulus that is going on in the world, inflation might come back. So, in US market, you can get an inflation protected ETFs also. I mean, and some people, like to sort of take more aggressive bets. You can have ETFs which will double the market return. You can buy an ETF that will go, basically invest opposite direction of the market. So you can essentially short the market and so on. So lots of choices. And I think, this is just showing you how different sectors have performed in US. So if somebody has a view on a particular sector, I mean, you can actually you can really take a bet on a specific sector and generate pretty substantial returns from doing so. Now, I want to kind of remind everybody or like share this quote from Warren Buffett. I guess no Indian presentation is complete without something, a quote from Warren Buffett. But I think this is something that he put in a 2013 letter, and I believe he repeated this in the recent AGM. That he's obviously he's an active investor, and he manages money himself. But his estate, for money for his family, his recommendation or his instructions are to put 90% of that in a low-cost S&P 500 ETF. And because he has believed, and he's said this many times, that most active fund managers will underperform this low-cost ETF. Now it's an interesting paradox, because index ETF like S&P 500 outperforms most active fund managers, because those active fund managers exist. They all compete with each other, trying to find every single the alpha opportunity. And those opportunities get taken out immediately, shared among multiple investors, and that's why it ends up being that S&P 500 becomes very difficult to beat. So, yeah. Next. I thought I shared some data on some of the ETFs that I have looked at more closely in the past also. I mean, if you look at this, I mean, technology has been a very strong sector last 10 years, and that is reflected in the performance. But I think, over a longer time, S&P 500 ETFs has given pretty decent returns. Obviously, you can also invest in gold. There's again a lot of talk about gold as an important asset class over the next year or two, given again the amount of money that is being pumped into the economies. I mean, I think one of the good things about the investing in the US ETFs is you get very, very clear data on where things are. I like to look at price to cash flow, dividend yield, expense ratio, and I think you can get all this information. Even the estimates of growth are also available. So one can take if one is interested in looking at sort of timing into different ETFs, that also is possible. In fact, there is also this mega cap growth ETF that is pretty popular, which is comprised of some of these largest companies. Obviously more expensive than many of the small and mid cap sectors. But I think just looking at this, it does seem like that even in US, small and mid cap have underperformed and appear to be more attractively valued today. Yeah, next. I think just a word on transaction cost and tax, because obviously that is an important consideration in any investing. So first, I can tell you that investing in US ETF, if you do it the right way, is far, far cheaper than investing in Indian markets. I mean, if you look at the Indian, if you invest in the US, in the Indian exchange, you're paying so many different taxes. So even if you work with a 0% brokerage, you start with at least 10, 12 bips of cost. And then that can go up to 60 bips or even higher, depending on which broker you use. In US, you can invest with a fixed amount of brokerage, sometimes as close to zero, sometimes as high as only $10, irrespective of the size of the trade. US does not deduct any withholding tax for capital gains on Indian residents. However, in India, this obviously income is subject to tax. So if it's a capital gain, nature of capital gain, you would pay long term or short term. The only thing to remember is that the period is longer. It's either 24 or 36 months, depending on the asset, and you pay 20% with indexation benefit. And short-term capital gain tax is a little more expensive. Obviously, it's taxed at a normal income. Dividends, US deducts 25% as a withholding on dividends, but that is subject. You can use that to offset your dividend tax liability in India. So there is no double taxation. And interest, US again doesn't take any cut on the dividend. There is no tax in US. So you have to report that in your Indian income and pay the tax according to your liability. So overall, I think it's you could say Indian equities have a small advantage. It used to be a much bigger when there was no long-term capital gains tax. And there is an advantage of a horizon also here in India. You can sell after 1 year and qualify for long-term. So those are some of the important things to remember about the tax. And I'm primarily talking about equities, and I'm sure it is the other assets. The US treatment doesn't change much because, as I said, the only thing that US does is takes withholding tax on dividends. So in terms of how the Indian investor invests in US, obviously there is this liberalized remittance scheme, LRS, RBI. You can go to the RBI website and get the details. Today sitting here at your in front of your computer, you can open an account with some of these brokers who offer this service in India itself, and basically remit money to that account and then start investing in US market. What we do actually is we track a number of indicators for both the US and Indian market. The P multiple, the Schiller P, which kind of gives us an indication of long-term trend in the earnings and in P. We look at the earnings yield and compare to the bond yield, market cap to GDP ratio, yield curve, leading indicators, and from that we sort of try to figure out how aggressively we want to be invested in equities vis-a-vis cash, and that's how. And then we primarily select some of those more simple ETFs. I talked about a range of ETFs that are available. We try to keep it very simple, and accordingly we invest in US, and that experience has been pretty rewarding so far. Next week. Just to give you a sense of this is a long-term chart of S&P 500 and how some of these indicators looked at key points, and to give you the recent experience. Interestingly enough, the multiples, what we call the bond earnings yield ratio, never really shot up. But what we did observe is inversion of yield curve. We sort of, one of the early warning signs that is often used. And when the market crashed, some of these valuations started to look very appealing. The bear ratio touched all-time low. And I think it became a very convincing point to re-enter the market. I think one can develop some simple techniques to also do decide how much to allocate to equities versus cash, or one can stay invested all through, and that also can work. Yeah. So with that, I think I'd like to stop here, and I think we'll happy to answer any questions.
Thank you, Bhavin. Thanks for that insightful presentation. I think we do have a lot of questions. To begin with, in general, I mean, most of the portfolio managers, when especially in India, I mean, the pitch is that you are developed markets have aging population, zero inflation, negative interest rates, maybe GDP growth is not there, excessive, whatever, monetary easing, your debt to GDP ratios touching maybe 200, 300%. I mean, considering all those macro factors, I mean, does investing in some of those markets still make sense?
No, I think that's those factors are there. In fact, coming out of global financial crisis, a lot of people have written off US and US markets, And I think that some of these concerns are definitely genuine. However, what I can say is that what has not changed is the the innovation ecosystem in the US. And I think is a reason why you keep seeing amazing new companies emerge out of that ecosystem and basically create wealth. And the other important thing is when we are investing in US companies, I already gave an example of how through US you can get exposure to more companies that operate around the world, not just US. But even the US based companies are not just US centric, as we all know. Apple depends significantly from on China, and going forward maybe India also, and likewise for many other companies. So while the US economy itself offers limited growth opportunities because of some of the reasons you outlined, US companies themselves are truly global in nature. So you basically participate in the global economy through these companies.
Sure. So I think you mentioned somewhere in the, during your talk about ETF being the preferred choice to access some of these foreign markets, including US, largely because the cost is low. Now, ETF by its nature would try to mimic an index. And if you are basically only trying to catch some of these innovations and, get some of these market leaders, how would that be possible? Because on either it is stock selection or either it is, index. I don't think retail investors or individual investors would have that much of analytical bent to basically get only the top leaders.
So as I said, one can go for sector funds. The technology sector fund, gives you sort of a higher exposure to the innovation-oriented companies, or even healthcare ETFs. You can, if one has a strong view on a specific subsector within technology, you can also get that ETF. I personally not do that very often because I think that requires a lot more research. But I think ultimately this gets reflected in S&P 500 because it's a 500 companies. If some companies doing well, it is going to rise through that 500 rank and basically help you with the performance. There are also equal weight ETFs. So there will be a ETF of 500 companies, but the weight is equal. So it kind of gives even the smaller companies can actually have a higher weight compared to their market cap in their ETFs. So some studies show that such ETFs have done slightly better in some periods than S&P 500.
Sure. So some of these ETFs, is there a minimum amount of investment, or pretty much you can start with any number?
You can pretty much start with any number. Only thing is the transaction cost. If you're paying a fixed amount of transaction cost, as I said, let's say it's $10, right? So if it's $10 and if you're buying only, say one share of ETF worth $50, then it is 20% of your, so it's very high, right? So that is the only disadvantage. Otherwise, you are able to buy as few as one share or as many as whatever you want to buy.
Sure. As a reminder to our participants, the poll has opened up, so feel free to basically address your feedback on the poll. Bhavin, now obviously you mentioned innovation, but there's something which typically equity investors look for, and that's essentially companies which are growing or economy which are growing. Now a QSR company or a Domino's for that matter would have much higher growth rates in India. Obviously, I don't have the growth numbers for US, but the growth rates will be much higher in some of these economies where the population is not aged, or essentially you have the demographics on your side. And India, China, maybe Philippines, to that extent, offers you some of those options. And so take an example of Zomato, maybe Swiggy, whatever is happening out there. So the penetration opportunity in some of these markets will be much higher than in US. Given the case, will you still go for US markets, or it really depends on sector to sector.
So, first of all, I'm not saying completely give up on Indian market. I mean, I think hopefully, we are seeing, some of these recent reforms, and hopefully we will, have a good equity story to work with in future. Hopefully some of the scandals that have affected our markets will diminish. And obviously last 10 years, you've seen so much bad news, that piled up on our markets. Hopefully that will reduce. And as a result, when you have, one yes bank, that, takes down that, meaningful part of an index, and obviously it affects the performance of that index. So yes, you are absolutely right that, some of these companies in India have much higher growth because of the low penetration. But, I'm also cognizant of value. Anything that is like that seems to get valued. Avenue Supermart is a great example. Happy to sit on another debate with anybody on how to explain that valuation. Whereas, in some cases, the India listed, and there is an MNC which is listed in some other market, and they have a subsidiary in India which is listed for historical reasons here. And you will find that valuation of that subsidiary is higher than the parent. And obviously that doesn't make any sense. So I would say that I'm not saying don't invest in India. Yes, there will be higher growth opportunities here, but I think you have a lot more options available outside India. And just like India, there are other emerging markets too, and you want to benefit from their growth as well. So that also you can do this. You can do that through the quote unquote US investing. I mean, it's really global investing through US market is what I would like to define it as.
Now, the local regulator, does allow the mutual funds to invest, globally. So there are, mutual funds which allows you to take exposure of China or maybe US or some of those. How different or, similar or better are those funds versus, exposure to direct ETFs?
So I think there are some which mimic the US-based index. And what we have in our study, we have observed is, obviously, because US market has done well, those funds have done better than Indian market. So yes, anybody who took that call has benefited. They didn't have to go through the LRS route. But what I feel is that to invest in just like when you look at a lot of investors sitting outside India and investing in some of these companies in India, I always wonder why they invest in this company. I mean, the ability to have the advantage of being on the ground is very, very important in my view. And to manage an active fund sitting in here, I think you have some limitations. So while some of these funds have actually done well, especially those who have taken exposure to some very successful US companies have done well by definition because US market has done very well. Whether or not they have actually created alpha is a different story. And some of these index funds that are available in India, what we have observed is the tracking error tends to be very high at times. Yes, I mean it's one way to get exposure to US market if somebody doesn't want to go through the LRS route. But I think the LRS route has become much easier today for an investor, and so that's why I would encourage people to consider that.
For some of these local mutual funds, do you have on top of your mind what's the average expense ratio versus the ETFs which typically are there in US?
I think if it's an actively managed fund, it's like typical Indian mutual fund expense ratios, anywhere from 1.5% to 2.5% or even higher. If it's an index fund, my guess is it's still at least 50 bips or higher compared to same ETF. I mean same index ETF available with an expense ratio of 5 bips.
Sure. Okay. So since you mentioned about diversification, there are times, especially black swan events, when everything goes in the same direction, irrespective of which market you are in. It could be 2008, could be what's happening right now, could be, other crisis. How do you view some of those events? I mean, especially when the diversification doesn't work.
Yeah, I mean, I think there is no easy answer, first of all. I mean, I think as an active investor myself, it might be ironical that I'm talking about index fund as an active investor. But I think, I think as an active investor, I do try to, take a cash call in that situation. And, obviously one cannot do it perfectly well, but I think it does, if done correctly, one can still save some money through that phase. But yeah, sometimes, as I said, there are, in some cases, the warning signs are available. And so just to give you an example, around when S&P 500 was about 2,800 a few months back, I think there were some red signs for the US market. And, my view was that one should increase the allocation to cash. From that point on, market went all the way to 3,400 or so S&P 500. And so there was a meaningful rally even from that point. But then it crashed all the way down to 2,100, 2,200. Obviously, because of this COVID-19 event, maybe if that didn't happen, who knows, market might not have crashed. Or maybe the economic issues may have caught up with it later on. So I think as an active investor, one can try to move in and out of the markets in such situations. I mean, as a normal, I mean, for a regular investor, one has to really have the asset allocation in a way that if then that happens, that's money that is then not going to be required immediately, and one can sit through that. I mean, and I think what is very clear is when we talk about long-term investing, I think the time horizon, the longer the better. I think it's more we're talking about in decades rather than in 3 and 5 years. Is I think what is important.
Sure. Does the SIP kind of a model also work in ETF, or is it more about can you really time it?
No, I mean you can see. I don't know. It depends on the broker. I'm not sure if they offer. Depending on the broker, they may or may not offer the automatic SIP option. Obviously, one can do it so quote unquote manually by having a discipline to invest on a particular day every month. But yeah, I mean, I think dollar cost. The original word for SIP was dollar cost averaging.
Okay.
So that concept is proven over time. So I'm pretty sure, and because of the low transaction cost, when you invest in US market, I think it should be feasible.
Right. Now, speaking about indexes, I mean, at least from an Indian perspective, Nifty 50 is not, the true representative of the economy.
Yes.
At the same time, if you look at BSE 500, I mean, you might have liquidity issues and you might have coverage issues. You might have stocks which are not covered, by any broker. So on one side, you can argue a little bit about research alpha. On the other side, you can, kind of talk about whether the comparison of S&P 500 versus Nifty 50 would really make sense. So, I'm sure large cap, or from overall index level, you can justify the case for US. But a similar case, can it be made for maybe a Russell 3000 or a BSE 500?
Yeah, so actually the performance of total stock market index in US is similar to S&P 500, not dramatically different. There are times when they vary, but over long term, it's not a huge difference. So when you invest in UK, US, you can even get exposure to that. And if we did the same comparison with CNX 500 that we have done with S&P 500, I mean the Nifty, I think the data will still favor the US. In fact, because Nifty 50 has done a bit better, if you bring in CNX 500, I suspect the arguments that are made are still going to be valid. Okay.
There is a whole lot of debate about active versus passive investing, and a lot of throttling happening about ETF leading to a theoretical bubble, where the ETF index, ETF or the fund keep on buying what is rising, because it has to basically get to a weight. So the higher P, high P becomes higher, and they continue to do that without, taking part in any of those, stewardship board or some of those. Any views on those?
So, I mean, I think I'm not sure about the argument for higher P gets higher. I'm not. Maybe I didn't really exactly follow why that happens. But I mean, I think both active and passive investing will have to coexist. If you take this to a limit, and let's say there is no active investing, then there will be mispricing of many stocks. So there will be let's say that all active investors, went to bed and there's no active investor in the market. Then there will be a massive mispricing of some stocks. So a new active investor can enter and really make a lot of money. And so I think over time, what will happen is again, more active investors will come and the opportunities will become smaller and smaller. And then ultimately that balance will come back. So I think both will coexist. I think some active investors will still outperform the market. But which ones will do has become more and more difficult to know beforehand because fewer and fewer ones do. And does the ETF investing lead to overvaluation of the market? I mean, I think for the US market where it is very easy to short the stocks, where unlike India, I think it's difficult for me to believe that kind of wrong valuations can persist as far as they have in India.
Understood. How about other markets? Like China, maybe Brazil, Australia, or EU. I mean, is it the geographical? I mean, I'm sure correlation plays a big role. But how do you view other markets? I mean, are there similar options available via LRS route to invest in those markets as well?
Yes, in fact, you'll have to find, if you want to really buy the local stocks in some of these markets, you may have to find a specific broker who can do that for you. So it's a bit more complicated perhaps. But yeah, I mean, there are options available through some accounts which give you exposure to multiple markets around the world. They may not be as cost effective as the US market investing, but options are definitely available to do that.
Sure. Now, when we talk about Indian markets, typically, from at least from a retail investor perspective or individual investor perspective, they're highly regulated. I mean, T+2, the contract note, the depository system, and the other framework is very, very sort of clearly laid out. How does it work in US? I mean, are all of these entities regulated? I mean, whatever you invest is safe and secure there.
I think US ETFs are governed by a US SEC regulation, and I'm not an expert on the safety aspect, I must say, but what I can say is from personal experience of looking at this index funds and ETFs over the last 25 years, I would say I have not heard of too many. I mean, I've not heard of frauds taking place, especially if you deal with reputed index fund providers, likes of Vanguard, for example. I don't think we have ever heard of that kind of situation from, say, Vanguard or Fidelity, for that matter. Who also
what I meant was not the fund house, but essentially the intermediary. So essentially, you're only buying through a broker or some intermediary, right?
Right. So yeah.
How does that work?
Right. So these brokers are also regulated by US SEC. Again, I mean, I don't think we have heard of too many scandals taking place. And where we have heard of scandals is in sophisticated products like hedge funds or fund of funds. I remember investing in a fund of fund which had a fantastic track record and performance to a very reputed private bank, the name that everybody knows about, and that fund had an investment into Madoff, and I lost a lot of money there. Whereas by investing in ETFs or even direct stocks, I don't think I've ever experienced a broker fraud or anything like that. So I'm just, I'm not an expert on safety, but what I can say is that my experience is that no, I think it's pretty safe.
Sure. And do most of these brokers also offer you like a demat account equivalent or a custody account where they maintain it, or do they maintain it in a pooled structure?
Yeah, so in US it is more like a pool structure. So you don't have a separate demat account. Shares are
Right.
held by the broker in in a pooled manner, and that's the reason, by the way, why also shorting the stocks is very easy in US. So yeah, so you just have one composite account,
Right.
that you open. Yeah.
Right. Now, I know you mentioned about taxation and you gave a brief on how the taxation system works. But there are questions about how to take credit on some of these withholding taxes which you have been deducted on dividends or interest or maybe capital gain. Is that an easy system, or do you really need a help of a qualified accountant?
So, I think I've been filing tax returns on a worldwide income basis for 15 years. And almost every year, I get questions from the tax department for a number of different reasons.
Right.
And for initial years, I must admit, they would also disallow my tax credit.
Right.
However, in recent years, it has become a lot more streamlined. But again, the Indian tax department, I don't guarantee that they won't ask unnecessary questions. But the law is very clear. If one is able to, even if questions get raised, if one has the help of the right chartered accountant, they can be addressed. And hopefully, with more and more people investing, I think the level of awareness about these rules will become more kind of common among the income tax officers, and hence, hopefully, fewer questions will be asked.
So we talked about stocks and ETFs and maybe funds. Can you do something similar on futures and option markets also there, or maybe commodities to that extent?
So actually, in the same account, you can do that. I mean, obviously, you'll have to file additional you may have to provide additional disclosure, not disclosure, but additional declaration. They will ask you a number of questions about your capability and risk appetite and so on. But you can actually do that through the same account. Actually, futures, options, commodity, ETFs. I don't think you can directly buy commodities in the same account, but you can definitely buy ETFs that mimic behavior of certain commodities.
Right. There are a couple of startups, at least which I have came across in recent past, which are offering you something similar by tying up with a broker and maybe taking help of a bank to do the LRS and stuff. Is there an easy way to check out their status, or any of the familiar names which you have seen over course of period about investing?
So I think some of the biggest banks they are offering those services. I would encourage people to look at the cost that they have to bear in going through that route, in terms of the transaction cost or any kind of fees and so on, and whether or not they're worthwhile. There are independent brokers who are not not linked to any of these big banks, which offer this service in a more cost-efficient manner, in my experience.
Right. Without recommending anyone, what are the few options available?
So as I said, let's say the biggest private banks, HDFC, ICICI, they offer, I think, some of these products.
Sure.
I'm not sure if any other, other private banks also do. But I suspect all the banks will try to offer this product as time goes. And so that's one. And second is some of these brokers like Interactive Brokers, for example, they also offer this service.
Sure. Are there ETFs specifically for gold? Gold is being talked about with whatever is happening around the world. Are there specific ETFs for gold or gold mining companies?
Yes, there is gold ETF. There is gold mining ETF. There is silver ETF. There are so many ETFs. I may not even know about many of them.
Sure. And what's your view on gold?
Sorry?
What's your view on gold?
Again, not an expert on gold. All I can say is I observe one thing, that post global financial crisis, when taps were opened by the US Federal Reserve, and there was obviously fiscal stimulus, and at that time I think it was done in phases. Here this time it is like in one big big bang. The money pumping has happened, That time, post global financial crisis, there was a period in which gold did really well. I think when maybe the quantitative easing was gradually withdrawn, gold stopped performing better than the gold stopped performing. So there is potential for that, to repeat to some extent. Some of the, some of uptick has already happened, but I am inclined to believe that that there is definitely a potential for that. There is definitely some risk of inflation coming back when you have so many economies around the world, synchronized in easing the monetary policy. So I think having some exposure to gold is actually, in my view, at least personally, I believe it's a good idea. I think how much, obviously, ultimately, it's an asset class that doesn't yield any income, but it's and I think we saw in our presentation, gold does have a negative correlation overall with the market. Although, as I said, in this periods of very loose monetary policy, gold can actually also perform alongside the markets.
Sure, sure. What are your views on currency? I mean, I saw a slide on Indian currency on an average depreciating by 2 to 3% maybe every year. Where do you see the dollar rupee? I mean, obviously, dollar currently remains the global currency where everything gets traded. But with whatever is happening with China and EU and uncertainty about EU, the supremacy of dollar will remain. I mean, is that an option?
I think there are two separate questions. One is what happens to rupee, and second is what happens to dollar versus global market. So as far as rupee to dollar, my simple observation, something I learned while doing my MBA, is that when you want to understand currency, look at the inflation difference in two countries, and that difference will explain the currency movement over a longer period of time, by and large. And I think that simple truth has held true by and large. You may not be able to answer the short-term movements of currency from that, but longer period. So, today, if India has, 4% inflation, and if US is having 2% inflation, a 2% depreciation is something that we can expect. Obviously, this inflation keeps changing, but whatever the differential is. So that's how I look at that. I think replacement of US with some other currency, again, was talked about after a global financial crisis. And at that time, the strong candidate was, guess what? Euro. Now, we know what has happened to European Union and Euro, and how, the Euro and European Union has weakened, not strengthened. For China to become, China has many ingredients to become a strong reserve currency, but it is missing a few very important ones as well. And, not being a democracy, being a closed economy, I think not having completely free capital markets, I think those are some really important things about China that I would say, come the way of it becoming a global currency. So, because of that, US dollar, I think, retains its stance as of today.
Correct. Now, obviously, US markets have performed very well in last 1.5 year. But this being the election year, what's your view on election and how does it impact market? I mean, from a valuation perspective, I think you suggested they are fairly valued. But how do you perceive next 6 months being, on the election side? Do you think Trump coming back?
First of all, on the valuation, I think what I said was they're relatively better valued than India. Okay. They are better. By historical standards, if you adjust for risk-free rate, they're still reasonably valued. But I think when market moves up so fast, even with a very tough economic environment, I think one wants to be a little careful. As far as the view on the US election, I really don't have a view on election. But I think my observation, and this is where I actually differed from a lot of economists, including those from my own university, that Trump will be good for the US equity market. He talked about the tax cut, and he implemented that, and I think that was a big factor in driving the US market. How much it helped the US economy, I don't know, but certainly played a big role in the US market's performance post 2017. So I think if he comes back, it's positive. All else being equal, it's positive for the market from that standpoint. And I'm not going to make a comment on his performance as a president and some of the decision making and so on. I'm just purely from an equity market standpoint.
Right, right. And given this whole backlash on China, do you see some of these manufacturing shifting out of those regions to India? I mean, do you think India would be a beneficiary in this Atmanirbhar and other things?
India has the opportunity, I think, and we are doing few things to make that happen. But I mean, it's not easy. I mean, I think there's I think the ease of doing business when we talk about it. I mean, I think, and the culture of the business-minded nature of the Chinese. I think it's difficult to pull industries out of China. But I think if we have the right policies, if we have if we make it really easy to do business over time, irrespective of whether it comes out of China or not, I think India can actually has the potential, given all the other factors that we are in our favor.
Sure, sure. Now there is one question which is not related to market, but I still want to ask you. Most analysts who are successful in their career want to become a successful portfolio manager. But only few manage. I mean, a successful portfolio manager may not be a successful analyst and vice versa. And I think you have transitioned from, a successful analyst to a portfolio manager. So what are the challenges and some of the things which have come up?
I think, see, obviously, when we talk about analyst, there is a sell-side analyst and there is buy-side analyst. There is an important distinction. I think I worked pretty much all my career as a sell-side analyst. So, it won't be fair for me to comment on what the career looks like for a buy-side analyst. So my comparison is between sell-side analyst and a portfolio manager. So I think the key, as a portfolio manager, there is a different level of stress when managing other people's money. The amount of pressure and stress that one goes through, especially in periods like this, is enormous, is much higher than what a sell-side analyst might go through. At the same time, sell-side analyst faces very different types of challenges. The pressure to publish research report every time there is some development in the company you're following. Trying to be ahead of the market. There are in India is a peculiar market, right? Because we have more sell-side analysts for every company than any other market in the world.
True.
And so the task of sell-side analysts here is very difficult. If you want to come out with a report that when you're going to see something different, it is not easy, especially in the large caps. But I think ultimately, whether you're a sell-side analyst or whether you're a portfolio manager, good basic fundamental research, having good lateral thinking focus, having sort of eyes and ears open, and all those things definitely help in either case. And I think most important is whether you enjoy the process of understanding something, figuring out something, whether this company, this business model is has any value, whether what this company is saying, whether it makes sense, trying to figure things out, unearthing the truth, so to speak. I think if one gets kick out of doing that, then both can be very interesting careers.
Sure. And one related question, typically it's very difficult to cover or at least, look at companies when you are away from that market. I mean, with an exception of Warren Buffett, who stays in Omaha and tries to cover everything. But does it make any difference, being in India and trying to scout for opportunities in the US? I mean, the same question is vice versa, where people in US are trying to manage, funds in India.
So that is why I have so far, not tried to do in US stocks very actively. There are a few companies I understand well. So I tried, I may try to dabble into those names. But yeah, I mean, I think the answer depends on what kind of business, what is your prior background. If somebody has lived in US before, traveled around the world, they may have a better perspective. I also would say that the quality of information available on US companies is quite good. So if one is willing to do hard work, and the filings to SECs are very detailed. So then one can still do a reasonable job, but I think it's without ever being to US, ever traveled around the country, or it can be challenging. I feel one may not get that feel for why something is going to be really successful, not successful. I think the context may be missing if one tries to do it that.
Sure. Well, thank you so much for sharing your insights with us today. As a reminder to our listeners, please do complete the evaluation survey that will appear on your screen as a poll at the end of the session or during the session. CFA Society India members may claim professional learning credits by logging into their online professional learning tracking tool. Thank you for participating in today's webinar, and thank you so much, Bhavin.
Thank you. Appreciate everyone joining.